Right now, American corn farmers are producing more corn than ever before in history and losing money on every single bushel. That sentence should not make sense, but it does. And what is happening underneath the surface of this story is far more dangerous than anyone in Washington is willing to admit publicly. Because this is not just a bad season. This is the beginning of a structural collapse that could reshape American agriculture for a generation. Let me explain. In 2025, American farmers harvested 17 billion bushels of corn. That is the largest corn crop the United States has ever produced. Yields hit a record 186.5 bushels per acre. By any measure of productivity, American farmers just delivered the most impressive performance in the history of agriculture. And yet, according to the USDA, corn futures are currently trading around $4.20 per bushel. That sounds like a reasonable number until you understand what it costs to grow an acre of corn in 2025. The National Corn Growers Association reports the average total cost to grow a single acre of corn in the United States this year is $897. At the record yield of roughly 187 bushels per acre, that puts the average break-even price at $4.75 per bushel. Some farmers in less productive regions need closer to $5.35 just to cover their costs. Do the math. At $4.20, the average American corn farmer is losing roughly 55 cents on every single bushel they produce. On a 1,000-acre operation, that is over $100,000 in losses in a single season. And those are the averages. Many farmers are doing far worse. But here is what makes this story truly alarming. This is not a temporary downer. The numbers from the USDA's February 2026 farm income forecast paint a picture that should worry everyone. Net farm income in the United States peaked at $210 billion in 2022. Since then, it has been falling. For 2026, the USDA projects net farm income will drop to $153.4 billion, a decline of $4.1 billion from the year before when adjusted for inflation. But strip away the government payments, and the picture becomes devastating. Without federal assistance, net farm income this year would collapse nearly 12%, falling to just $109.1 billion. Let me say that again. If government checks stopped arriving tomorrow, American farm income would fall by almost 12% in a single year. And those government payments are not small. The USDA forecasts $44.3 billion in direct government payments to farmers in 2026. That is nearly 29% of total farm income coming from the federal government. Those payment levels have not been seen since the height of the COVID pandemic and the trade disruptions of Trump's first term. As one agricultural economist put it, government payments are doing a lot of the work in supporting crop producers right now. This is not a market functioning. This is a market on life support. Meanwhile, costs are not going down. Since 2018, total production expenses for American farmers have increased by more than 36%. Fertilizer costs, fuel, machinery, seed, labor, everything that goes into growing corn has surged in price. In 2022, when corn was selling for over $8 per bushel, those costs were manageable. Today, with prices below the break-even point for the third consecutive year, those costs are suffocating. And here is where the debt story starts getting frightening. Total farm sector debt in the United States is projected to reach $624.7 billion in 2026, an increase of $30.8 billion, or 5.2% from the previous year. Both real estate and operating debt are rising. Farm bankruptcies surged 55% in 2024. In the first quarter of 2025, that pace doubled compared to the same period a year earlier. In some regions, non-performing farm loans now exceed 4.3%, the highest level since 2020. Agricultural economists are calling this a first warning sign of broader stress ahead. In Purdue University's AG Economy Barometer surveys, 31% of farmers in January 2026 said their operating loans were growing because of unpaid debt from prior years, a sharp increase from the year before. That is not expansion borrowing. That is survival borrowing. Farmers are taking out new loans to pay off old ones just to keep the lights on. Now, why is the price so low when farmers are losing this much money? The answer is simple but painful. The United States produced so much corn that the market cannot absorb it. Ending stocks for the 2025 to 26 marketing year are projected at 2.2 billion bushels, a 7-year high. That is a massive surplus sitting in storage while demand has not kept pace with production. Feed use is at record levels. Ethanol demand is strong, but total consumption simply cannot match the volume of corn pouring out of the Midwest. And every week that corn sits in storage, it costs money. Moisture damage creeps in, quality declines, and in an oversupplied market, lower quality means even lower prices. But this domestic oversupply is only half the story. The global picture is where things get truly complicated, and where American corn is facing threats that many farmers never anticipated. For decades, the United States was the undisputed king of global corn exports. In the mid-2000s, America controlled roughly 60% of all corn traded internationally. That dominance seemed permanent. It was not. Today, the United States accounts for roughly 30% of global corn exports. The country that took a significant chunk of that market share is not who most people expect. It is not Canada. Despite some narratives circulating online, Canada produces roughly 14 to 15 million tons of corn per year compared to America's 432 million tons. Canada's total corn exports are about 2.8 million tons, most of it going to Ireland, Spain, and the United Kingdom. Canada is a niche player. The real competitor that reshaped the global corn trade is Brazil. In 2023, Brazil surpassed the United States as the world's largest corn exporter for the first time in history. Brazilian corn shipments reached 2.2 billion bushels that year compared to 1.8 billion from the United States. Brazil achieved this by aggressively expanding its safrinha, or second crop corn, investing billions in northern port infrastructure to reduce shipping costs, and critically, by striking a phytosanitary agreement with China that opened the world's largest import market to Brazilian corn. In 2023, China became the primary destination for Brazilian corn exports. Brazil's rise was not accidental. It was strategic, methodical, and executed over a decade. Argentina adds further pressure. Despite periodic drought issues, Argentina remains a major corn exporter with roughly 29 to 30 million tons in exports. In December 2025, the Milei government cut corn and sorghum export taxes from 9.5 to 8.5%, making Argentine corn even more competitive on the global stage. Together, the United States, Brazil, and Argentina account for almost 60% of all corn traded globally. Ukraine and France fill out much of the rest. The competition among these top suppliers is fierce and getting fiercer. And then there is the China problem. China used to be one of America's most important corn customers. In recent years, Chinese corn and wheat imports have been plummeting. China's own corn and wheat harvests were both record large in 2024 to 25, and their massive domestic stockpiles mean they simply do not need to import as much. Chinese corn imports are projected to fall 57% from the average of the previous 4 seasons. When the world's biggest potential buyer pulls back this aggressively, every exporter feels the pain. But American exporters, already contending with trade tensions, tariffs, and geopolitical friction, feel it most acutely. The tariff situation deserves special attention because it reveals how policy decisions can cascade into agricultural catastrophe. In early 2025, the United States imposed sweeping new tariffs as part of the escalating trade conflict. China retaliated with tariffs ranging from 10 to 125% on American goods at various points, including agricultural products. While both sides eventually negotiated lower rates and agricultural exemptions, the damage to buyer confidence was already done. When you are an importer managing billions of dollars in procurement, you do not wait for trade wars to resolve. You find alternative suppliers. You sign long-term contracts with someone more predictable, and that is exactly what happened. On top of direct tariffs, the United States proposed port fees targeting Chinese-built vessels. The initial proposal would have charged up to $1.5 million per port call for ships built in Chinese shipyards. Given that Chinese shipyards account for roughly 53% of the global commercial ship order book and about 70% of global new ship orders, this would have affected a massive portion of international shipping. While the final rules scaled back these fees significantly and largely exempted agricultural bulk carriers, the mere announcement created uncertainty. The American Farm Bureau warned that higher shipping costs could shift buyer preferences toward lower-cost producers. One agricultural marketing consultant described the situation bluntly, saying the United States has sold itself for many years as a reliable and trustworthy supplier, and that reputation is now at risk. Then there is the GMO question, which represents perhaps the most structural long-term threat to American corn exports. In March 2025, Mexico, the single largest importer of American corn in the world, enshrined a ban on the cultivation of genetically modified corn in its constitution. Now, the immediate impact was limited. A USMCA dispute panel ruled in late 2024 that Mexico's import restrictions on GMO corn were not based on science and violated the trade agreement, and Mexico formally complied by withdrawing its import ban. However, the constitutional amendment creates a legal and political framework that could support future restrictions. Imports of American yellow corn for animal feed continue for now, but the door is open for tighter regulations, stricter labeling requirements, and enhanced risk assessments that could create barriers over time. Here is the deeper issue. Approximately 93% of all corn grown in the United States uses genetically modified varieties. This has been the foundation of American corn productivity for decades. GM corn offers higher yields, better pest resistance, and lower chemical inputs. But as more countries signal preferences for non-GMO supply, whether for scientific reasons, cultural reasons, or as trade leverage, that 93% becomes a vulnerability rather than a strength. Access to markets is starting to matter more than sheer volume. A country can produce 17 billion bushels, but if buyers increasingly prefer or require non-GMO corn, a significant portion of that production becomes harder to place at premium prices. This brings us to what is actually happening on the ground right now. The USDA dramatically slashed its 2025 net farm income estimates by $25 billion from its September 2025 projections. That is not a minor adjustment. That is a wholesale rewriting of the farm economy narrative. The data was supposed to be released in December 2025, but a federal government shutdown delayed the report. When the numbers finally came out in February 2026, agricultural economists described the delay as having made it harder to assess stress in the sector, meaning the warning signs were obscured precisely when clarity was needed most. The farm economy is now experiencing what the American Farm Bureau calls a generational downer. Net farm income is approximately $48 billion, or 24%, below the record highs of 2022. Production expenses remain at record levels. Working capital is declining. Farm solvency is worsening. The debt-to-asset ratio is forecast to rise to 13.75% in 2026, and while that number alone is not alarming by historical standards, the trajectory is. Every metric is moving in the wrong direction simultaneously. The comparison to the 1980s farm crisis is being made more frequently, and while the situations differ in important ways, the parallels are unsettling. In the 1980s, farmers borrowed heavily during a period of high prices and rising land values, then faced a catastrophic price crash that left them unable to service their debt. Today, the mechanism is similar. Farmers expanded and invested during the boom years of 2020 through 2022, when corn was above $6 and even $8 per bushel. Now, with prices below $4.50 and costs barely budging, many are trapped. The only difference is that government payments are currently cushioning the blow, but relying on $44 billion per year in government support is not a sustainable agricultural policy. It is a stopgap. So what happens next? The United States faces a choice that extends far beyond agriculture. The first option is structural reform. This would mean investing in export infrastructure to reduce shipping costs and improve competitiveness. It would mean developing non-GMO corn production at scale to access markets that increasingly demand it. It would mean modernizing inspection and certification systems to match the speed and transparency that international buyers expect. It would mean recalibrating trade policy to reduce friction with key import markets rather than escalating it. None of this is easy. None of it delivers results in a single season, but it addresses the root causes of the problem. The second option is continued protection. More subsidies, more emergency payments, more short-term relief. This approach keeps farms alive in the near term, and that matters. Real families and real communities depend on these payments. But protection without reform has a cost. Every year of subsidies without structural change is a year where competitors like Brazil and Argentina strengthen their position, sign longer contracts, and deepen relationships with the buyers that American corn used to serve by default. The global corn market is not going to wait for the United States to figure this out. Brazil is expanding its ethanol industry, which increases domestic corn demand but also diversifies its agricultural economy. Argentina is cutting export taxes to boost competitiveness. Ukraine, despite the ongoing war, continues to export impressive volumes of corn. New players like Serbia and Myanmar are growing their export presence. The market is evolving, and it rewards countries that reduce risk for buyers, deliver consistent quality, meet environmental and regulatory standards, and provide predictable supply chains free from political disruption. American farmers are not failing. Let me be absolutely clear about that. American farmers just produced the largest corn crop in the history of the world. The yields they achieved are extraordinary by any global standard. The productivity of American agriculture remains unmatched. But productivity alone is no longer enough. In today's global market, access matters as much as output, trust matters as much as tonnage, and policy matters as much as planting. The numbers do not lie. Record production, record debt, prices below the cost of production for the third consecutive year, government payments approaching 29% of farm income, competitors gaining ground in every major export market, and a trade policy environment that creates more uncertainty than confidence. This is not a crisis that arrived overnight. It built slowly, season after season, policy decision after policy decision, and it will not resolve itself. The question is not whether American agriculture is in trouble. It clearly is. The question is whether anyone with the power to act will do so before the window closes.